Bloomberg Audio Studios.
Podcasts, radio, news.
This is a joy. This is something Paul's demanded that we get from MacroPolicy Perspectives. Constance Hunter in here with Julia Coronado, and to have them, Paul, on this day is just, I just think that killer. Julia, does this shift Powell's discussion of the character of our disinflation, this stunning report?
I think it's an important report. I think Chair Powell is likely to express some optimism that progress has resumed after a disappointing first quarter and that the plan to lower rates is on track. We think that they'll come out with a 2-cut baseline. This report sort of solidifies that. We think that Chair Powell sort of has that control over the median and the message, and that he can sort of credibly express optimism, say that we saw some broad-based progress in today's report after a decent April. So if we get a few more prints like that, then they can begin a process. The Fed is now having to deal with the decision of, do we start early so that we can go slow, or do we wait till weakness arrives, which is the track record of central banks, right? Wait till weakness arrives and then cut quickly. This is a new approach, or a relatively untested approach. She's laughing at me because
she knows I'm going to go mental.
Yeah.
Paul, save me. Put the surveillance cork in my mouth. Paul, save me.
Constance, there's a lot of folks out there that says this Fed is already behind the curve, that they should be cutting already. Do you guys, how do you think about that?
I think that is a valid perspective. But of course, they also have, there's people who are saying that there's going to be no landing, that the Fed isn't going to cut at all this year. So I think I understand the perspective of the Fed of deciding to wait, given the prints that we had in the beginning of the year, and given the fact that we're seeing anomalies in the CPI data that we didn't see prior to the pandemic. And so I think from their perspective, caution is the better part of valor. On the other hand, as Julia said, historically, they are late. And so I think that they do run that risk. Fortunately, the jobs print last week was stronger than expected. But our big concern, if they're late, is that labor market starts to weaken. And once you see that, it's too late because it is at best a coincident indicator.
Right. And Julia, Joe Weisenthal from Bloomberg Lots podcast just moments ago said, raising some concerns about the labor market here. That 4%, you got to pay attention to that kind of number. So, how do you feel about the labor market?
Yeah, no, I think that the May employment report was truly mixed, right? The payroll number is strong. It was broad based. But the household survey is showing rising slack. You have to take that message at face value. The fact that we have gone from a low of 3.4 to 4.0, it's still a low unemployment rate, still a healthy job market. But, it is is more balanced than it was before. There are risks on both sides now. And as Constance said, if you keep restrictive policy in place for too long, then you're going to lose that resilience. So even actually Governor Waller said this earlier this year. He said, the low-hanging fruit of bringing down job openings, without a rise in unemployment is probably behind us. To really see a decline in labor demand from here, you're going to get that alongside a rise in unemployment.
We're going to come back. It's just a joy to have Constance Hunter and Julia Coronado with us. But Julia, I got one fundamental question. Are we more than ever, John Edwards in Louisiana, as you were studying in Texas, are we more than ever two Americas? And the idea of aggregate analysis at the Eccles building is just quaint.
I think there are always lots of Americas.
But is there more now? Is it more polarized now in terms of
politically?
paycheck?
Absolutely, we're in a very polarized. Economically, no. I would say, Tom, actually, the good news is that we're less polarized economically, in a sense that the lower wage workers had the best labor market they've seen in generations this cycle, and it hasn't cracked yet. Really, the weakness we see in the labor market is at the top. It's the professional service sector jobs that are experiencing the weakness. So I would say actually we've seen a narrowing in wage inequality this cycle that we haven't seen in 30 years.
It's just a bang-up day here, folks. We have Jim Bullard with us, the former president of the St. Louis Fed, and here for a half hour, Julia Coronado with us and Constance Hunter of MacroPolicy Perspectives to get us towards the Fed meeting this afternoon. Most importantly, at 10 o'clock, Paul Sweeney will drive forward with Alex Steele. I mean, you got something to talk about after this inflation report.
We got again a very interesting inflation report. Something very important for the Fed to take into consideration here as we hear from the Fed. And you're going to have full coverage this afternoon, right, Tom? Starting.
Can I go odd?
Sure.
Mexican peso weakness.
Oh, I don't know where to go there.
Is just stunning.
Yep.
We have Julia Coronado in the room. You think we should go all Mexican peso on
do
it?
that.
Yeah.
Well,
there it is.
That's political risk for you.
Yes,
Yeah.
exactly. And the bond market action we saw in France yesterday, on just a rumor, there's a lot of uncertainty.
What a joy to have us here for a half hour. Julia Coronado and Constance Hunter of MacroPolicy Perspectives. Constant, I love Neil Dutta. He doesn't mince words. May I quote, Paul?
Sure, let it rip.
It does not take a rocket scientist to figure out what needs to be done.
Yeah.
And he's like, let's go. Fed needs to get on with it. Constance, what are they waiting for? I mean, I get it, they're ex post. We all know this. Can we really hope for a new regime where they get on with it?
I mean, one thing that is going to hold them back is that shelter print. Now, that was isolated to New York rents, which went up and played an oversized part.
No. How much did 2 blocks in New Jersey play? Paul, step in here. Are you telling me national inflation was Paul Sweeney's housing fault?
I think it was Paul Sweeney's fault in particular, yeah, he's to blame. You should get all the hate mail. No, but seriously, they're going to need to see that shelter number come down a bit. But I don't disagree. Look, September has to be firmly on the table. The markets believe it's firmly on the table. And even a Fed that's a little bit behind should be able to move in September.
Joey, how do you think about the U.S. consumer here? Because we're getting inflation's coming down, but it's still at that high reset level, up 19% versus 2019. How's the U.S. consumer doing today?
Look, I'll reframe it this way. We should thank the U.S. consumer because one thing we keep hearing in earnings reports and in the Fed's beige book is that consumers are price sensitive again. Mm-hmm. When we look at things like goods prices, broad-based deflation, consumers want deals and they're getting them on cars, on furniture, and on apparel this month. So
on airfares.
Airfares plunged. So consumers are back to that norm that they had before the pandemic of, to part with my money, you're going to have to offer me value. And that is helping restore healthy inflation dynamics. So they might still be grumpy from what we've all been through. Mm-hmm. And we also, as Tom had alluded to, see a lot of polarization in those sentiment numbers. But the reality is that consumers have taken control back. That pricing power that companies enjoyed during the pandemic has evaporated, and now they need to deliver value. So some of those margins are going to get pressed.
We had a GDP number first quarter. Where are we? 1.3, 1.4%, whatever. Atlanta GDP balloons out 4%. They bring it back. Now we're running. What's the run rate? To both of you, do you guys argue about this? What's the run rate on real GDP? Are you that far apart, the two of you?
I don't think so. I think we're both at about 2.4, 2.5. I mean, you have to look at GDI when you look at this, and last quarter was really trade and inventories, right? And so the question is, how much are those inventories going to be rebuilt? That's a very tricky thing to forecast. And then obviously we have the strong dollar, which is hurting trade in some respects, but we also see tailwinds from the global economy that we haven't seen for 4 years that could slightly help our trade numbers.
I mean, it comes down to domestic final sales. Mm-hmm. What's 12 months for? I mean, Julia, you were at BNP Paribas years ago making headlines on this. What's domestic final sales look like 1 year out? Don't give me this gloom stuff.
No, it's not gloomy. I think we're both very constructive on a better productivity cycle, not just because of AI. AI hasn't even begun to enter the room yet. This is about a healthier labor market. It's entered the stock market room, but not necessarily the productivity numbers. We've had a strong investment cycle. We've had a good labor market, good matching of employers and employees. And we're not deleveraging. Last cycle was all about deleveraging and global fragility and financial fragilities. And we have strong balance sheets and a healthy, broad-based economy. So I think we are pretty constructive that we've got a better productivity trend. We've got immigration, at least for now. That's going to be a big policy differentiator in 2025. But for now, the U.S. economy looks like it can run, above 2% and not generate inflation.
Apple's up 9% since the gloom of the AI presentation.
Exactly. That's
209.
This is just the AI bump that everybody was looking for, and they got it up another 1% today.
You told me not to buy it.
I probably did. Too expensive, but here we go, up higher again.
Hey, Constance owns NVIDIA, so.
There you go. Very good. Very good for you.
For a while, actually.
Good for you.
Now I need to start trimming that position.
Just keep loading it up by the momentum. Constance, what would you like to hear from the Fed chairman today versus maybe what do you think we will hear from the Fed chairman?
Yeah, that's a great question. I mean, I'd like to hear him say that as long as inflation is making progress towards 2%, that it will be appropriate for them to take away some policy tightness. And let's remember, where is our star? Let's say it's higher. Let's say it's 3.5, right, instead of 2.5. Let's say it's there. They can start cutting and still be restrictive. And so I'd like that message of we can start cutting and policy will still be restrictive.
Okay, so economic historian from the University of Texas, is there any heritage that we do that besides a Greenspanian measured after the fact? I don't observe it. I mean, Richard Timberlake at Georgia or McTeer at Dallas Fed years ago, no.
Yeah.
There's no history of what Constance Hunter just said.
History of what you just noted is Greenspan, is the mid-90s, mid and late 90s, where they kind of ebbed and flowed the Fed funds rate. It went up, it went down, it went up, it went down, and without a recession. And it was about fine-tuning and keeping the expansion.
Does he have to address that today as Lagarde and Company
he might.
addressed it at ECB?
I certainly hope that the Bloomberg reporters in the room ask him that very question, because they need to have a strategy. That's the one they've been communicating.
Rich, take a memo. Coronado wants to tell McKee what to say.
Well, and you brought up McTeer, and he was the one arguing for the productivity revolution. He was the one arguing, saying we're going to be getting productivity, and we need to make sure that we don't raise rates into this stronger GDP. Because if you recall, in the second half of the 90s, GDP started to gain momentum after those 3 rate cuts, while inflation fell.
The 90s, late 90s were very good to me.
They were good times.
I don't remember. I'm too young.
So, Julia, I've been trying to explain to my kids who are in the workforce now that this is a more normalized rate environment. The zero stuff we lived through before.
Yes.
Is that kind of where we are now?
Yeah.
Are we back to normal, I guess?
I hope so. I mean, I think we're in a positive real rate environment. It looks like the economy can handle that. So I agree our star is probably higher. That's where we wanted to end up, right? That's what the whole idea of the last strategy review at the Fed was about, engineering a somewhat higher run rate on inflation and gaining some policy space. And I think signs are that that's exactly where we're heading. That will give them better trade-offs. I know, I'm going to say this and people's heads are going to explode. We've got a better mix of fiscal and monetary policy now. Of course, 6% deficits are not sustainable forever, but what we have had is better state and local government, better fiscal participation. The Fed isn't carrying all the water for the economy.
You guys aren't allowed to travel together for safety, but have you guys talked about how you adjust your Fed calls seriously to the end of the year? Did you make a switch this morning? Will you publish for MacroPolicy Perspectives switch this morning?
I think what we've been flagging for our clients is that the outcome of today's meeting and the tone and the tenor is going to depend on this morning's data. It is an important data point, and if we get what we were below consensus on inflation, it came in at our actually even a little bit below our forecast, but that would lean towards a more positive, constructive message that we're going to start in September. So I think that's where we're at. The data has ratified that orientation, and now it's up to Chair Powell to deliver the message.
And Paul, Ian Lingen is a third of a way to a stunning call in the 10-year yield. Yep. 4.28%. Yep. I'm not saying it's going to drive lower, but that's what BMO Capital Markets is saying.
Yep, exactly. So where's Constance? Where are you guys thinking about GDP this year and next year? How's this economy going to be growing?
Yeah, so we had originally been thinking we would have a soft patch this year because higher rates would begin to take a bite out of growth. And now we're thinking that if the Fed can act and that in time, that may be able to be avoided. And part of the reason that's going to be avoided is this productivity story that Julia was talking about earlier, right? And all of the aspects of that are playing out in the economy. So we're looking for a little softer than last year, and then a little bit of a pickup probably in the second half of 2025 as lower rates continue and feed into growth story.
Way too optimistic. Constance Hunter, Julia Coronado, MacroPolicy Perspectives. Can we do this again? This has been
fun.
great.
Yes.
Thank you.
Absolutely.
Thank you so much.